So, continuing our discussion, and again, I did say this is going to be a bit of a talk fest for a while, so we've still got a few more concepts to get through. We ended discussing insolvency and liquidity or illiquidity. Then we're also going to distinguish between interest rates and asset prices. Stocks, bonds, and short-term securities and loans are collectively called financial assets. Okay? The price of an asset and the interest rate on that asset are determined simultaneously, and one implies the other. The relationship also means if the interest rate on the asset rises, the price of the asset falls, and debt becomes harder to pay or it should be repay, and net worth of a financial institution falls. What does that mean? Sorry, this was just someone asking about what it means to leverage up. Okay, so generally what happens is the price of a bond, if you've done any finance, and I'm pretty sure you've done some of this in maths already, the price of a bond is in general, let's go like this, is in general an inverse function of the interest rate. Okay, so it's a negative function of the interest rate, the price of a bond. If I put there price of a bond. Okay, so the simplest kind of a bond would be a perpetuity bond. Okay, a perpetuity bond is a bond that never repays the principal. It only ever pays interest, and it pays something called a coupon. I'm pretty sure you would have seen something like this in maths. But if we say that the price of a bond, okay, we're going to talk about a perpetuity bond. The perpetuity bond, the price is going to be 1,000. What that's going to be equal to is the coupon, whatever the coupon is, divided by the interest rate. Okay? Okay? So if the coupon is 100 and the price of the bond is 1,000, what must the interest rate be? Yeah? Are you happy with that? Okay? So if the price of a bond is 1,000 rand, the interest rate is 10%, the coupon is going to be 100. Now a perpetuity bond always pays the same coupon. If the interest rate changes, so let's say the coupon staying at 100, but the interest rate is changing from 0.1 to 0.2, what must the price of the bond change to? The interest rate goes up to 20%, the price of the bond will be what? Price of the bond would fall to 500. Does it not? Did I do that calculation wrong? What's 100 divided by 0.2? 500. Yeah. In other words, when the interest rate goes up, what happens to the price of a bond? Price of a bond goes down. Okay? Now I've used something called a perpetuity bond. Now you can take any kind of bond you want, and the nature of the relationship is the same. When interest rates go up, the payment that a bond makes will always remain the same. It always pays some fixed amount of money. So when the interest rate goes up, the fixed amount of money remains the same. The price of the bond itself decreases. So if you are a bond trader, what that means is if you hold government bonds, you've purchased government bonds at some price, and you purchase those government bonds, and let's say that they pay a coupon of 70 Rand, what that means is you purchased those government bonds at a price of 1,000 Rand, the coupon was 70, the interest rate was 7%. Okay, that's what it means when you buy a government bond. Okay? If interest rates change because, for example, the Reserve Bank raises interest rates, okay, the price of your government bond will go down. Okay? So if you are a bond trader and you're holding government bonds, you've purchased them at a price of 1,000, and you expect interest rates to go up, what should you do with your bonds? You expect interest rates to go up, you're a bond trader, what do? You hold bonds currently. You expect interest rates to go up, what should you do? You should sell your bonds at the current price of 1,000. When the interest rate goes up, the price of those bonds will fall. You can then buy back the bonds at a lower price. You've made a profit. Right? That's what bond traders do. Of course, that's called a zero-sum game because whoever bought the bonds loses, right? So you win, they lose. It's called a zero-sum game. My plus is equal to someone else's minus, right? Okay, so interest rates and asset prices are inversely related. Inversely related. Okay. So just to bring this all back to what we've been, to our diagram that we saw in chapter 21. Remember, households are going to be lending money through financial markets. That's what we're dealing with here, financial markets. Households lend money called savings through financial markets to firms. Firms are the borrowers. And what do they do with this money? They invest. Okay? So savings goes through financial markets, becomes borrowings, firms borrow and they invest. Okay? When we were talking about chapter 23, we introduced our first economic model of the labor market. Labor market as well as a production function. This is the labor market. So here's where labor markets come in. It's the markets for factors of production. It's the labor market. Okay, so that was chapter 23. This is financial markets, chapter 24. Okay. So the point is that savings become investments, but savings are not the only kind of investment. Okay, households can save, but also governments, if they have a budget surplus, they can channel that surplus into investments, and we can also borrow from the rest of the world. Okay, so the way that we can see this is to write our equations from before. Let me actually make this a bit bigger so I've got a bit more space. Remember, any income to households becomes consumption, savings, or taxes. Okay? And any expenditure must be in the form of consumption expenditure, investment expenditure, government expenditure, or net exports. So exports minus imports. So we can equate these two equations. C plus S plus T must equal C plus I plus G plus X minus M. Okay, we can cancel the C's because those are the same. And what we're going to see if we rearrange this is I can write it as the following. S plus T, and I'm going to put a bracket here, T, and I'm going to bring G to this side. So plus G becomes minus G, right? So plus T minus G plus, and I'm going to bring these two things to the other side as well. So minus M becomes plus M plus X becomes minus X, and all of that must equal I. I'm leaving I on that side, okay? If government taxes are greater than government spending, then the government budget is in a surplus. It is getting more revenue than it is sending out through expenditure. Okay? So this is a government surplus. If we are importing more than we are exporting, okay, when we import, okay, more than we export, what are we doing? We are basically saying to the rest of the world, when we import more than we export, so if we export, we send some goods to the rest of the world, but we taking back more of them, right? When we take more goods from the rest of the world than what we send, we're saying to the rest of the world, please, can we borrow some goods and services from you? Okay? We're taking more than what we're giving to you at the moment, which means we're borrowing from you for now. Yes? Sorry, start again? Yes? Yes? Cool. So I'll answer that as soon as I finish this equation. I will go from this equation back to what you're asking. Okay? So we've got savings can finance investment. A government surplus can finance investment, and we can borrow from the rest of the world to finance our investment. You happy with that? So all I've done is I've rearranged this equation to show you that we can finance investment, funds that finance investment, either through savings, budget surplus, or borrowing from the rest of the world. That's each one of these items. Back to the circular flow diagram. What is a leakage and what's an injection? Okay. So the leakages are these green things here. Okay. Here's the household. It gets money. It gets income. Okay. And it spends it directly, or it directs it out to financial markets, okay? Either through taxes or through savings. So both of those are leakages. They both go out. They don't go directly to goods markets. They go out somewhere else. Through financial markets, they go to someone else. Through financial markets, they will go to firms. Firms will then take those funds that exited the financial flow, that leaked out, and will re-inject them through investment spending. Okay? So you see the savings plus taxes are both leakages. Okay? Investments is an injection back in. Okay? Taxes as well, they go away from the households and they come back through government as government spending. Any taxes that go out to government can come back in through government spending. So government spending on the other side here, there's another injection. Okay? Taxes, remember, if government doesn't spend those taxes can also go through financial markets back to firms who are borrowing from government and then spending through investment. So, can come back through investment as well, those taxes. When we purchase from the rest of the world imports, right? Those imports are not from our firms, those are from someone else. So that's a leakage from our internal circular flow. Okay? Whereas any selling that our firms do to anyone else, right, is an injection back into our economy. Okay? So exports are an injection, right? And if I move this minus M to the other side there, right? Minus M, that's a leakage. It becomes plus M on that side of S plus T plus M. Those are all leakages. Okay. So if we look at this equation once again, all these positive things, the savings, taxes, and positive M here, those are all leakages. Here's your injections, and injections. Okay. So if this thing here is positive and this thing here is positive, they must come back in through investment. Okay. Everyone happy with that diagram? Okay. Let's talk a little bit more about the real interest rate. And first thing we're going to do is distinguish it from the nominal interest rate. So the nominal interest rate is basically the amount of rands that a borrower must pay to a lender. Okay? The real interest rate is take that nominal interest rate and adjust it to remove inflation. Right? So the difference between a nominal interest rate and a real interest rate is exactly the same as the difference between any other nominal and real variable. Right? So the nominal interest rate, it's worded badly here. It's not the number of rands. An interest rate is a percentage. Okay? But the nominal interest repayment will be the amount of rands that are being repaid. The real interest repayment would be what is the value of goods and services that actual amount can buy, right? So there's a nominal interest payment and a real interest payment. Now, because a nominal interest payment is different to a real interest payment, a nominal interest rate is also going to be different to the real interest rate. Okay? And the same way that we adjust nominal and real variables is the way that we adjust nominal and real interest rates. We just adjust for the effects of inflation. And the way that we would do it, you can do it in a proper fancy equation. Oh, you know what I forgot to do? I forgot to check that equation for Lin 2 and the rule of 70, but I will do that. Yeah, let me just write that down to remind myself. Okay. What happens with the real interest rate is the same. We can write the real interest rate is approximately the nominal interest rate, which I'm using I, so this is nominal interest rate. Nominal interest rate. Okay, R over here means real interest rate. Real interest rate. Okay, the real interest rate is approximately the nominal interest rate minus the rate of inflation. And I'm just going to call inflation here pi. Okay. Those squiggly equal signs means approximately equal to, right? The real equation would be divide. This is not a minus, it's a divide. So we take the nominal interest rate and we divide it by the inflation rate to get the real interest rate. So you would take 1 plus R is equal to 1 plus I divided by 1 plus rate of inflation. That's the proper equation, right? Okay? Okay, so let me just, the proper equation says 1 plus R is equal to 1 plus I divided by 1 plus pi. Okay? But we can approximate this equation using this equation here. So we are adjusting the nominal interest rate for the effects of inflation in order to get the real interest rate. And then what we're going to do is we're going to plot the real interest rate, okay, real interest rate, against the quantity of funds that are available or for lending, so that are going to be exchanged in the loanable funds market. So the loanable funds market, the quantity of funds against the real interest rate. And the first thing that we're going to deal with is demand for loanable funds. And surprise, surprise, the demand for loanable funds is downward sloping. There is a negative relationship. So there are two factors that determine investment. So when we talk about demand for loanable funds, who is going to be demanding loanable funds? It is people that borrow. And who are the people that borrow? The people that want to invest. So demand for loanable funds is investment. Okay? Those are the guys that are borrowing through the loanable funds market. And there are two things that are going to influence the demand for loanable funds. The one is the real interest rate. Okay? The second is the expected profit. So why real interest rate? Well, the relationship between the quantity of loanable funds demanded and the real interest rate, I'm not sure why it's over there, real interest rate is negative because when we borrow these funds, we want to invest. Okay? And the interest rate is the cost of borrowing those funds to invest. The higher the cost of borrowing, the less we want to borrow in order to invest. And that is also related to expected profits. Why? Because when we invest in buying machinery. We invest in buying a factory. We invest in buying, things that are going to go into the production of output. Okay? So when we produce output, we expect some sort of profit from that output. Okay? We will need to pay for whatever we've invested, for whatever we've borrowed. We need to pay the interest rate for whatever we've borrowed from that profit. Okay? So the higher the expected amount of profit, the more interest rate we can pay, right? The higher the interest rate we can pay. Are you with me? Yes or no? Okay. Remember the concept of diminishing marginal returns, right? The more projects I invest in, the less the return I'm going to get from those projects, the less the expected return from those projects, right? So the more I intend to invest, the less the expected profits I'm going to be making from these investments. Why? Because the return I'm going to be getting on these investments generally is going to be lower. Because the more I'm going to be buying capital, the more I'm going to be building stuff, the lower my return on each one of those things. Okay? So the more I borrow to invest, the lower my expected return on those investments. So what's going to induce me to borrow more? Lowering the interest rate. The lower the interest rate, the more I can say, okay, well now I can actually go and do more projects which are going to earn lower returns. The lower the interest rate, the more projects with lower returns I can invest in. Right? Because I need to borrow money in order to invest. If I'm borrowing at a high interest rate, I can't invest in low return investments. But if I can borrow at a low interest rate, I can invest in low return investments. So the lower the interest rate, the more I will borrow because the more I can invest. You get the idea? Downward sloping demand for loanable funds. Of course, this is expected profits. So the same that happens in microeconomics and the same that happens in the labor market and the same that's going to happen throughout this course, when expectations change, right, then our entire demand curve shifts, right? So in other words, this is our demand curve given what we expect in the future. We expect investments to yield certain types of returns. And based on the interest rate, I will borrow some amount of money in order to invest given what I expect, right? So my downward sloping demand curve says I will borrow more funds given what I will borrow more funds the lower the interest rate given what I currently expect my investments to be doing. But if I change my expectations, suddenly I think, hang on a minute, the economy is not doing well, my investments are probably not going to do well, I expect my profits to fall. What that means is that at any given interest rate, I'm going to be demanding less funds for investments. So exactly, what's it going to do to my demand for loanable funds curve if my expectations change? If I expect profits, if I expect profits to fall, if I expect the economy to do poorly, my demand for loanable funds is going to shift to the left. So that's so this is a change in expectations, but it's a negative change in expectations. Right? Suddenly I'm not confident about my profits. My demand for loanable funds shifts to the left. Okay. So changes in the demand for loanable funds. When the expected profit changes, the demand for loanable funds change. The greater the expected profit from new capital, the greater is the amount of investment, the greater the demand for loanable funds. So that's the demand side. Surprise, surprise, there is a supply side which is upward sloping. Okay? Why we have an upward sloping supply curve? Again, interest rate, what is it telling us? Who is saving? Who's supplying loanable funds? It is savers. In other words, the people that are lending. Okay? So the higher the interest rate, the more the return on any money you lend to someone else. So the higher the interest rate you are going to get on your money, the more you are happy to lend. Why? Because when you save, you are not consuming. Okay? So there's a cost to saving. Your cost to saving is I can't consume today. Right? By not saving, I am denying myself some sort of satisfaction today. And that's a cost. And I need to be compensated for that cost. And that compensation comes in the form of an interest rate. What the interest rate tells me is the following. Next period, when you receive your interest rate and get paid back your savings, you will have not only the amount that you had today, but the amount that you had today plus a little bit extra. So you get a reward for not spending today and instead spending tomorrow, right? You get a reward for delayed satisfaction. So you get an interest rate. And the higher the interest rate, well, the more likely you are to say, okay, I'm happy to wait, right? I won't spend 100 Rand today if you give me 200 Rand tomorrow. I won't spend 100 Rand today if you give me 1 million Rand next year. Yeah, okay, cool. Right? Take my 100 Rand, right? And in fact, there's interesting experiments that they've done where they ask people the following question. It's like you can take something in 100 days, right? It's like you can have 100 Rand in 100 days, or you can have 110 Rand in 100 days plus one, in 101 days. Which would you prefer? And people are like, we'll take 110 Rand in 101 days. Thank you very much. You know, like, whatever, who cares? Why would I take 100 Rand when I can take 110 Rand in 1 day extra, right? Awesome. And then they ask the same group of people the same question. Would you rather have 100 Rand tomorrow or would you rather have like 100 Rand later today or 110 Rand later tomorrow? And people be like, yeah, I'll take 100 Rand today. Sweet, right? So you have exactly the same discount rate, but at different periods of time, and you make different decisions. It's called hyperbolic discounting. So you don't discount at the same rate, which is very interesting. Anyway, if you're into behavioral economics, it's pretty cool. So, supply of loanable funds. Back on topic. Upward sloping. Why do we want a positive interest rate? Because we're more happy to save with a higher interest rate. And what influences where the supply of loanable funds is? In other words, what shifts it either to the right or to the left? There are 4 things that can shift it. Those 4 things are your current level of income, your expected future income, in other words, once again, expectations, your current levels of wealth, and your current expectation of how risky this current venture is. In other words, if you think that there's a lot of risk attached, you're going to demand a higher interest rate. Your supply of loanable funds curve shifts to the left. But having spoken about it briefly, let me leave you now to do something. Because you've got 3 more minutes before the... No, you don't have 3 more minutes. Please. I think I've made this mistake before. Okay, maybe not with this class. Okay, we've got 18 minutes. That's fantastic. Okay, I won't keep you for 18 minutes, fine. But what we are going to do is this question here. Well, this question here. Okay? So, with your textbook and with the discussion on the supply of loanable funds is this question. It says, which of the following statements apply to the loanable funds supply curve? Okay, so with your textbook, here we go. I'll leave it up to you for the next 5 minutes, and then we'll answer it, and then you can go and do what you need to do. Well, I mean, you're welcome to go and do it now if you want to, but... The discussion is on page 531, if you are looking for that. now. Are we ready? No. One more minute? No, you may not see the options right now, and I'll show you why. You'll see why, but yeah, we're not seeing the options right now until we're ready. So when we're ready, then we'll go through the options. Yes. Okay, yeah, one more minute. Do you want one more minute? Just let's do it. Okay. Okay, so let's talk through them. Option number one. First of all, it's worded a little bit strangely, but number one, changes in the real interest rate. Let's just deal with that first, ignoring this. Changes in the real interest rate lead to movements along the loanable funds supply curve. Happy with that? Okay, yeah, that's cool. This and the quantity of loanable funds is, I don't really know what that even means. So we'll see why that's not a problem in a moment, though. Okay, which is a bit ridiculous, but anyway. It's worded funny, but I'm not sure what that's supposed to mean. But yeah, obviously a movement along the loanable funds curve leads to a change in quantity of loanable funds, right? Different points along the loanable funds curve correspond with different quantities of loanable funds. I think that's what it was trying to say, just poorly worded. Option number two. Changes of disposable income, so changes of should maybe be in, changes in disposable income and expected changes of, or changes to expectations of future income cause shifts of the loanable funds supply curve. You happy with that idea? Okay. Change of disposable income and expectations, both of those are factors that can shift that curve. Let me put it over here. Number three, an increase in household wealth due to capital gains leads to a decrease in the level of private savings, which shifts the loanable funds supply curve to the left. Yes. Yeah. Okay, so on page 531, and we can talk about it briefly, but page 531, there's a discussion here about wealth, okay? An increase in current wealth, if your current wealth goes up, what you tend to do is consume more as a result and save less, right? Now, today, your wealth goes up, you save less and you consume more. That's what we do. You win the lotto today, you don't go, oh, you know what, I should save more, right? You're like, new house, new car, family members, how do I get away from them, you know, that kind of stuff, okay? Sorry, question I shouldn't hear, yeah? Yeah, I'm listening. Yeah, you can think of it like that if you want to. Yeah. Yeah, sure. Yeah, if that works for you. Yeah, I'm happy with that. Okay. So 1, 2, and 3, those are fine. Number 4. An increase in household wealth due to capital gains leads to a decrease in the level of private saving, which shifts the loanable funds supply curve to the right. So we're saying no, it's not going to be to the right. And then number 5, increased default risk leads to a decrease in the supply of loanable funds, which was shifted to the left. You happy with that? Okay, now I will go through the answers and demonstrate to you why I did not want to show you the answers. First of all, you will notice that option 1 okay? So as long as you are happy that it's not only option 1, we then have option 2 in every other option, as well as option 3 in every other option. So really it's just a question of Are options 4 and 5 correct? And option 4 can't be correct if you think option 3 is correct, which means we can go, right? So then, is option 5 correct? It's not the best question I've come across. Okay, so next week Thursday, I'll just begin again recapping demand and supply, and then continue with this chapter. Okay? It's the next one on my list. That's not a video. Yeah.
Sorry, sir. I came in a bit late.
Yeah.
So I missed practice 2. I just have a question practice 2.